Unit 4, Risk and Return, Lecture 8, Portfolio Performance Measurement, Part A. We're going to start this lecture by talking about security market indices. Now, security market index is a measurement of a section of the securities market. It is a tool used by investors and financial managers to describe the market and to compare the return on specific investments. Two of the primary criteria of an index are that it is investable and transparent. That is, the method of its construction should be clear. And investors can choose some security market indices representing various asset classes, including equity, fixed income, commodity, property, and hedge fund indices. When an index is being constructed, index providers must decide why and how the index will be constructed. And they need to answer some questions. Which target market should the index represent? Which securities should be selected from the target market? How much weight should be allocated to each security in the index? When should the index be rebalanced, if it should? And when should the security selection and weighting decision be re-examined? When deciding which target market the index should represent, the considerations need to be given to whether you're going to use a broad definition or whether you're going to define it very narrowly. Is it going to be based on asset classes, geographic regions, the exchanges on which securities are traded, or any other characteristics? In deciding which securities should be selected from the target market, the target market determines the investment universe and the securities available for inclusion. And once that investment universe is identified, the number of securities and the specific securities to be included in the index must be determined. So if we look at the Johannesburg Stock Exchange, we have all shares in the market. And if you want to look at the top 40 shares, as we do with the top 40 index, you'll identify those and they can determine whether it's done by market capitalization, as it's done here on the JSE, or by some other criteria. As mentioned in the previous slide, they need to decide how much weight should be allocated to each security in the index, and there are a number of methods that they can use. We'll come up against them later on in more detail, but there's the price weighted, the equal weighted, market capitalization, as they tend to do here in South Africa, and fundamentally weighted. For price weighting, in a nutshell, they take the price of the security they're interested in and they divide it by sum of all the prices of the securities in the index. For price-weighted index, the unique property that they have is that share splits don't affect the value of the index. Adjustments are made to ensure that this is the case. The advantage of a price-weighted index is it's simple to calculate and understand. The disadvantage, it results in arbitrary weights for each security. So a security that might be small but have a really high price counts for quite a bit in the index when it shouldn't. Equal weighted, very simply, if you've got 10 shares in the index, each share counts 1/10. The advantages of equal weighting in an index is that it's simple. The problem with it and the disadvantages is that securities that constitute the largest fraction of the target market are underrepresented. You may have a small fraction that is overrepresentative, and the problem is every time the prices change, it changes the weighting. So you have to constantly rebalance to maintain the equal weighting. Market capitalization is the price of a share times the number of shares in issue. So using a market capitalization weighting means taking an individual company's market capitalization and dividing it by the total market capitalization of the constituent securities in your index. The advantage of a market capitalization weighting is that securities are held in proportion to their value in the target market. The disadvantage is that if you have a significant rise in prices or a significant fall in prices, then their weights in the index will be higher or lower than they should be. So here, in creating a fundamentally weighted index, you're not looking at any factors that are related to a company's security price. It's actually factors that are related to, for example, the book value of a company, its earnings, its cash flows, and the like. So as in the case of the weighting for all the other categories, when calculating the fundamental weighting of an individual company, you will look at its fundamental factor value over the total value for that fundamental factor across all the constituent securities. When an index has been constructed, it then becomes important to maintain and manage the index. And two important factors in this process are rebalancing, and this involves adjusting the weights of the constituent securities in the index, and reconstitution, the process of changing the constituent securities in the index. And questions need to be asked about when these processes should be done. Now, just creating indices is not recommended, obviously, unless there's actually a good reason for them. So when and why are market indices necessary? Well, they are used to gauge market sentiment. If you listen to the news every day, they'll talk about how the JSE All-Share Index went up by 2% or it went down, and that gauges market sentiment. It's used as proxies for measuring and modeling returns, systematic risk and risk-adjusted performance. When we talked about the CAPM model, I mentioned that the market is represented by an index, and that's what it could be used for. Proxies for asset classes in asset allocation models, benchmarks for actively managed portfolios. So an asset manager who's managing an all-equity fund may use the JSE All-Share Index as their benchmark, and model portfolios for such investment products as index funds and ETFs. We know that Satrix and Satrix 40 are two ETFs. The Satrix is based on the All-Share Index, and Satrix 40 is based on the Top 40 Index. Now, looking more specifically at indices based on asset classes, we have equity indices. There are a number of them that exist. They can be broad market indices, broad market index such as the All-Share Index, multi-market indices from different countries, multiple security markets, a sector, different economic sectors on either a national, region, or global basis, or a style index. It can be market capitalization, value, or growth, to name a few.